The past week in Nigeria's financial markets offered an important reality check for investors. After a strong start to the year, the equity market recorded its first weekly loss, while the fixed income market saw renewed activity driven by liquidity conditions, auction outcomes, and evolving expectations around inflation and monetary policy. In today's conversation, we're going to break down what really moved Nigeria's stock market and fixed income markets over the past week, and more importantly, what investors should be watching in the week ahead, from the upcoming FGM bond auction to liquidity dynamics and the balance between risk and yield across different asset classes. So today I'm delighted again to be joined by my friend Oladipo Ajayi. Oladipo Ajayi is head fixed income at Chapel Hill, Durham. Oladipo, how are you today?
Yeah, good day, Dr. Capo. How you doing? It's nice being on the program once again.
Yeah, great. So let me take from you. How's the week been so far for you?
Well, it's been great until today.
What do you mean?
Well, I think the week has been great until the match between Arsenal and Man U today. I guess that's
Okay.
actually what.
Okay, I get what you're saying. There are always times like that, but hopefully you guys are still going to be able to win the league. But let's talk about markets now, because there are also joys that come from the market, as you would agree with me.
Yeah.
Okay.
Yeah. For markets, last week it was a great week altogether.
Yeah.
Most especially when you look at what happened in the fixed income segment of the market, we noticed a bit of renewed interest in the market. And when you look at what happened at the auction, the NTB auction, where we have on the 364-day paper, the total subscription was north of 3 trillion. So it tells you that currently we have renewed appetite for the markets, and of course the yield are actually very attractive. Of course, it's enough to actually lure anybody to the market, and beyond that also we saw pockets of activity on the bond side as well. On the mid-tenor instrument, the belly of the curve, the 33, 34, 32, 31, 30, 29. We saw a bit of activity on these instruments, and yield dropped by an average of about 40 basis points last week, and I think that's on the back of the level of liquidity in the system, the posture of the the central bank, and coupled with the fact that they are actually very, very good return in the market. So all in all, it was a good week. When you look at the equity market, of course, there was a bit of lowness in the market, but nothing to actually dampen the total gain.
Yeah, I was going to ask you about the equities market first before we actually talk more about the fixed income market. So what were the primary factors that contributed to the first weekly loss that we've seen? How did performance differ across sectors like banking, oil and gas, and the consumer goods?
It was majorly the specific names that actually drag the market into that negative on Thursday trade on Thursday, and some of the names are WACO. WACO, they are foreign investors are actually trying to exit their position. The foreign investor is actually selling a sizable volume, and that's actually put a bit of pressure on the market. On Thursday, of course, on Friday, we noticed renewed interest because WACO actually closed in the positive terrain on Friday compared to where it actually closed on Thursday. And that's not only on WACO. Same thing happened on Zenith. Zenith traded as low as 70 naira on Thursday. This is an instrument that actually traded as high as 73, 74 naira. And but another thing we noticed was on Friday was more like a renewed interest. People that are currently sitting on cash took the advantage and they repositioned the market to take advantage of that low level. Don't forget that we are getting closer to any season results, and
Yeah.
which simply means that in no time we start seeing our company actually churning out their results. And most portfolio managers currently are trying to restructure their portfolio. And you don't also forget that there are asset managers like PFAs that also are very particular about um, dividend payment. Of course, because of the peculiarity of PENCON regulations. So a lot of them are also rotating into asset class that will actually pay dividend. And I guess that's one of the reasons why we noticed that renewed interest. Also, it's not even only peculiarity that, because we also noticed that a bit of sell down on GT core on Thursday.
Yeah.
But
Dipos, so sorry to butt in. Is this a concern about asset valuation or profit taking?
I think it was basically portfolio manager trying to take profits. And another thing, some people are actually doing more like a switch. They are moving from one particular instrument to another. So
Okay.
maybe you are selling down on like a GT to move into another banking name, or you are selling down on GT to move into maybe into the breweries or into the oil and gas space. For some it's more like switching. So for some it was purely actually taking profits. Most of these portfolio managers, majorly the foreign guys, they've been sitting on some of these assets at a very low level. So
yeah, they are
sometimes when it
taking
comes to the
profits,
market,
right?
yeah. So when it comes into the market like this, there's no cause for alarm. They are just at a point in time trying to actually catch it on the game.
Okay. I know you already started talking about the auction, which is the Treasury auction that took place in the past week. So, what insights can we draw from the strong participation in that Treasury auction? And is that giving us a renewed appetite? Does this show like a renewed appetite for short-term instruments?
So I think for me, I think that's exactly what actually happened at that auction. It was an auction where we saw close to about 3.4 trillion worth of subscription on the 364-day paper. And a lot of guys actually missed that because out of that 3.4 trillion, the DMO only allocated about 977 billion. So it simply means that close to about 2.4 2.4 trillion worth of funds actually, actually in the market trying to actually try to actually cover their positions. And to a great extent, we also saw the impact of that in the secondary market because this instrument closed at 18.36 at the auction before the end of trading section on Friday. It was already trading around 17.15, 17.10 levels. When you compare that to where it was offered, that's a whopping about 126 basis points drop.
Yeah, basis point.
Yeah,
drop.
that's just within two trading sections. To my mind, the renewed interest in the market. A lot of people are actually looking for where to actually push funds as we speak currently, and there's a lot of opportunity in the market, and that's one of the reasons why we notice that level of activity in the market.
Yeah, and one of that thing we must not also fail to consider is the liquidity condition of the market. So the market appears to be extremely liquid. But how did the liquidity surge affect movements in the bond market as well? Did you experience anything in the Euro bonds and other fixed income securities during the week?
Yeah. On the local bond side, there was a bit of activity on the local bond side. At the beginning of the week, the market opened very soft, and I think we also felt the impact of the auction. And basically, when you look at the level of subscription at that auction, it tells you that there's still a lot of appetite for some of these instruments. And on the back of that, we saw renewed interest in the ball space, and majorly everybody were looking at the belly of the curve corridor. We saw the 2032 traded as low as on the upper side around 17.4 levels, where on the bid side, sorry, on the upper side around 17.2, on the bid side around 17.445. And this is the instrument that at the point in time I was trading very close to 18%. At the point I was trading 18%. So it tells you that despite the level of volume that's currently on the bond calendar for bond circular for the month of January, that's enough, and it's not enough to dampen the appetite of the market to be able to actually consume some of these instruments. So for us, we feel that it was a positive week in that regard. On the Eurobond side, beyond what's happening locally, what's happening globally is actually the major driver of that segment of the market. At the beginning of the market, beginning of the week, we noticed a bit of dovish posture, mostly on Nigerian sovereign Eurobond. But I think from Wednesday, it was purely a bullish week for the Eurobond. Because a lot of investors came back to the market, take advantage of the market, and yield actually drop. So when you compare the closing of the week to the opening of the week, it would be good to say it was more like a positive also week on that segment of the market. Beyond the sovereigns, we also noticed activity on the corporate as well. Names like Access Pep, names like the Seplat, names like the ETIs as well. There are pockets of demand on that segment of the market as well.
So these instruments are providing some significant return when compared to the FGM bonds. Is that correct?
Yeah. When you look at,
I'm talking about the corporate bonds now. I'm talking about the corporate bonds that you mentioned.
I would say beyond the Access Pep that's still currently trading around very close to 9%. Others are currently trading around 7%. So marginally, you will say they are actually trading above the govies. But when you look at it from tenor perspective, most of these govies are actually they're actually long dated instrument compared to some of these instruments. You look at Access Pep, this instrument may likely be called this year or early next year. You also have Access 26 that's maturing this year. You have Fidelity 26 maturing this year. You have UBA 26 maturing this year. So the only instrument that you can say a bit longer, when you start looking at Seplat 2030, you are looking at ETI 2029 and ETI 2031. And those are just basically the outstanding instruments that are more like longer than a year. When you look at the whole universe of the corporate bonds that we currently have in the market.
Okay, I know you talked about a few of these instruments that will be maturing this year. Have we started thinking about potential implication of these repayments on our reserves or foreign exchange market?
I don't think this is a problem for because currently these funds are not currently sitting in a reserve. Most of these banks already make provisions for repayment, and some of them they may likely come to the market to actually reissue. To actually fund the maturity. We've seen Fidelity Bank actually follow this strategy at a point in time before the current instrument in the market was actually funded by the matured instrument. So same way, we may likely see pockets of some of them actually coming back to the market to do that. But in terms of being readily available to actually make good obligations, I think most of these banks, they make provision for some of these funds. So it shouldn't be a problem on the market. And also, this fund is not sitting It's not sitting in central bank reserve. So we don't feel that will be a problem for the country.
Okay. We know the big one is going to be taking place tomorrow, which is the FGM bond auction. And there's a 900 billion naira target that the DMO is looking to raise. What are you watching most closely? Are you looking at the bid to cover ratios? Are you watching out for what the stop rate is going to look like, tenor preference, or allocation concentration? And what outcome would you consider hawkish or dovish for the market?
Well, for me, I think my focus is majorly on the 2035 maturity. Don't forget, this instrument was not just issued once last year, that was January, with a coupon of 22.6. So I'm actually trying to see how the DMO is going to actually work around that this particular point in time. Are they going to be dovish on this instrument, or they are going to be hawkish on this instrument? Of course, we are not currently having so much volumes when you compare with others that are actually on the calendar. However, we felt that this particular instrument will, to my mind, I think that it will be likely close lower than the other ones on the calendar. One, I feel it's going to have a lot of patronage. Why? Because of the coupon. Portfolio manager loves instruments with high coupon levels because it helps their cash flow activity. So on the calendar, when you see instrument that is actually with a coupon of 22.6, and there are others that are actually presenting a lower coupon, of course, you may likely be tempted to actually toe the route of the one with a better coupon. And that's one of the reasons why I felt that will get a lot of patronage. Of course, the other ones will also see interest in the other one, considering the volume that's going to be offered to the market. But for me, to my mind, I think that the auction will likely be oversubscribed. But I don't think it will likely be up to like ratio 2-to-1 because when you look at the volume, this is not a treasury bill that is short dated. For treasury bill, because it's short dated, we tend to see a lot of investors that may actually want to participate in this. The main participant in this auction will basically be a portfolio manager. And so I think if we are able to get like a 1.6, 1.7, 1.8 bid to cover ratio, it won't be a bad auction on the part of the DMO, considering the volume that they are actually shunning out to the market.
Okay, I was going to ask you, are you expecting the DMO to be able to raise the entire 900 billion they seek to raise this month? And what's your rate projection for the instruments on offer?
So I think that the DMO will likely be able to raise this fund. We've seen DMO come to the market. I think it was last year when the DMO was in the market, where they raised instruments around they raised about 2.5 billion at one auction. I think it was February 25 or February 2024. Yeah, where they were in the market and they were able to raise close to about 2 billion at just one auction. So I think that they have the capacity to do that. Market has changed, market dynamics have changed, liquidity is sitting in the market. And also a lot of people are currently looking at opportunity to actually invest. And don't also forget that we're having maturity. For the 2026, we expect the liquidity to hit the system. And immediately liquidity is the system, you likely see a lot of portfolio manager trying to actually reinvest this instrument, this cash flow. We're expecting about 1.2 trillion to actually hit the system from the bond maturity of the January 2026 bond. So with this level of liquidity, that will also help or cushion the effect of that huge volume that the DMO actually have on the calendar.
Okay. So where do you think the real demand in this auction will come from? Is it from PFAs, banks, asset managers? Are we beginning to, or should we expect offshore investors? And how does the buyer mix? How do you think the buyer mix will shape the secondary market dynamics next week?
I think the deep pocket guys that will first come to mind would be the PFA guys. And when you look at their level of assets that these guys are currently sitting on, So he actually explained the reason why we feel that they will be very, very active in the market. And also with the maturity that we're expecting, most of these guys are only surprised if over 50% of this maturity will actually belong to PFAs. And most of them will likely want to actually take advantage of the current elevated yield levels to actually reinvest some of this. So I think I would likely see a lot of PFAs in the market. And secondly, as well, the foreign investors also will also be present in the market. We've seen them a bit active in the secondary market. Part of the activity we saw in the market sometime last week, 2 weeks ago, is spoiled by some of these foreign guys as well. A lot of them are also taking advantage of the elevated yield level on the bond space to actually invest. So when you look at it from that perspective, they might likely want to come back to the primary market where they know that they can get sizable volume without price variation. So I will expect them to also be in the market. And beyond that as well, they fall within the purview of what bank can invest in. A 10-year bond is more like an intermediate tenor. So it means that banks can also invest in this. So I think these, the PFAs, the foreign investors, the banks, and also individuals, high net worth individuals will also be very active in the market.
Okay, so let's see. You didn't give your stock rate projection.
So I think market will actually close sub 18%. So I will range them with it between 17.6 to 17.8.
Okay. Is that for the 2035?
But 2035 will likely close lower than the 2034.
What about 2031?
2031, we all know 2031 in the market. Currently, that instrument is oversubscribed currently in the market in terms of the volume that's been issued to the market. So we may not see a lot of interest on that particular instrument. Major interest will actually go to 2034 and 2035. So I think 2031 we may not get that sizable volume on it. As a result, the DMO may likely cut the rate without actually fully allotting that volume to the market. So, but for me, I feel that 34 will close higher than 35.
Okay, but you expect the three instruments to close below 18%.
Yeah, I expect all these instruments to close below 18%.
Okay,
because I don't see DMO actually actually carrying out another level of promo, knowing fully well that there's a maturity, or the maturity that just the instrument that just matured into the system. So it means that there's liquidity in the system. So I don't see them actually doing another level of promo.
Yeah, I agree with you. And obviously, we've been talking about this in several episodes about the debt servicing costs. I think it's also in the interest of the DMO to be able to manage or help the government in that direction. Let's talk more about the equities market. Now, the equities market, as we know, often reflects a combination of local fundamentals and global signals. So looking ahead at next week, what key factors do you expect to drive the NGX direction next week?
I think what will drive the NGX direction is sometimes what happened in the fixed income space. As yields continue to nosedive, that will create a bit of opportunity for people that will actually want to move their fund into the equity space, considering looking to get better capital appreciation and dividend yield from that segment of the market. And also beyond that, like I mentioned, we are entering the earnings season where we expect most of these companies to start releasing results to the market. That will be another level of driver because a lot of people are currently positioned. They're currently positioning around what will be the performance of some of these companies. People are already taking a bet on the likely performance of Q4 performance of most of these companies, the banks, the bureau, the people in the consumer space, and also the oil and gas guys like the Seplat, the Aradel, And so a lot of people are already positioning around it. Also, MTN, don't forget MTN paid an interim dividend of 5 naira. So expectation is that their final dividend would be nothing less than 20 naira. So we've seen investors actually position in that segment, different segment of the market. So we feel that will continue to actually drive market dynamics. Will there be profit take? Of course, we'll likely see some people come to the market to take advantage of the current appetite of the market to actually exit position. But when you look at it in the longer, we feel that market will still hold its ground. Year to date, market has gained 6.36%, and not a bad one. If market continuing in this momentum, before the end of the year, we'll likely see another 50%.
Another 30 to 40% return. Right?
Yeah.
Okay. So macro signals from central bank can also influence cross-asset positioning at this time, especially as we begin to look forward to that all-important February meeting of the MPC. So in the light of the recent reserve increase and the CBN's macroeconomic guidance, so how might this affect market stability, relative opportunities in the equities market versus the fixed income market? Because we already started seeing that decline in yields in the fixed income market. Are you expecting further market guidance? Are you expecting that the CBN's current macroeconomic posture would tilt the balance between where opportunities are in the equities and the fixed income market?
Yeah, I think for me, I don't think that will likely tilt it because the market will both market has different level of investors. Most especially when you're looking at foreign investors in this perspective, there are some of it that are actually monitoring or actually mimicking an index, and some of them are just a bit active in our market in that direction. When you look at the part of the central bank, they are actually doing their bit. They've actually ensured that the currency has been stable over time. The reserve currently is at 46 billion. That is the highest since 2018. And one thing is that for me, the main thing is even the confidence that the foreign investor has in the data presented that's been presented by the current CBN administration. They've been very, very open. Sometimes towards the end of last year, they released both the gross and the net reserve of the country. So to a great extent, it helps foreign investors to know how secure they've been. And also the projection for them based on the report released by the central bank is that they expect this year that the reserve will close around 51.04 billion. Sometimes it will hit that level, sometimes this year. And in a time when in time past, in season like this or in period like this, where we see a bit of softness in the oil market, we tend to know the level of volatility that we normally see around Naira. But that has not been the case. Naira is very firm. The central bank barely intervened in the FM market. There was a report that was released that the H1 volume of FM trades last year went up by about 262%. So the total trade for H1 last year. Yeah, exactly. The total volume of trade, I think, was about $52.47 billion, and that's actually massive. And when you compare to where we're coming from, around 14 billion, so it means that there's a bit of confidence in the current central bank administration, and that's actually attracting inflows into the market, which also has been helping the currency to actually stabilize. And also, so I feel that we'll continue to see a bit of inflow of funds into the market. You mentioned earlier on that yields have been dropping, but when you look at where we were in November, we were at 15%, 15.3% on the bond side as of November last year. That's dropped about 50 to 60 days ago. But here we are now, 17.3, 17.4 levels. That's about 20 200 basis points up. So I still feel that yield at 17% is still extremely very attractive for anyone that actually wants to come to the market. So if you know very well that the currency is stable, like I mentioned, currency is stable, and you can actually take a gamble around that, actually bringing inflowing effects to actually buy a Nigeria local bond. Before currently, a 10-year instrument is currently trading maybe about 3.6% in the US. Currently, a 10-year instrument in Nigeria is trading about 7.8, 7.6 when you look at where we'll likely close at the auction. So it simply means that you have about 1,500 basis points to actually play with, and that gives you like an hedge in the event that there's any volatility in currency. So I think that a lot of people want to play that game, of that carry trade game also. So that will also continue to actually help the naira to sort of stabilize and also attract investors to the market. So for bond and the equity market, I think that they will likely witness a lot of patronage from foreign investors this year.
All right, so Dipo will get into that point where we'd like to pick your brain now. So from a strategy standpoint, what guidance would you offer retail investors for the coming week? Should they be leaning towards equities in anticipation of a rebound, or favor in fixed income given the upcoming auction and the attractive use in that market?
You know, for retail investors barely play in the bond space because when you say retail investors, of course, that's why the savings bond window was created to actually cater for this segment of investors. But for a retail investor that is still very young, I think the equity markets will actually present a very good opportunity. Of course, I don't expect you to want to buy today and sell tomorrow. There are pockets of names that we feel that actually they are good names, and when you look at names like Aradel has been actually trading with a bit of interest. When you look at names like Atex, you see GT, you see Zenith, you see Nigerian Breweries. So a couple of names in the market that actually.
Yeah, I said you seem to like Aradel because I hear you talk about Aradel a lot.
Hello, I lost you there.
Okay, so I was saying that you seem to like Aradel because I hear you talk about Aradel a lot.
So one of the reasons.
Oh, sounds okay.
Yeah. Can you hear me?
Right. Yes, I think your device, can you properly position your device? We kind of lost you momentarily there. Okay.
So, like I was for Aradel, I think it was Aradel is giving me something like a deja vu that happened on Seplat because I know very well at a point Seplat was trading about 800, and you know how a stock is trading 800, you're like, where else is this stock is going?
Where else can this go?
But to speak, but currently this stock is trading 6,700 in the market, and I think they look that their models are actually look almost similar in terms of acquisition, in terms of expansion, in terms of diversification. So I feel that it looks like a stock that in years to come will actually trade at a very big value, and that's one of the reasons why I feel that Aradel is actually a good stock to buy.
Okay. I think we've come to the end of our discussion today. Thank you so much, Dipo, for joining us. Dipo Ajayi is Head Fixed Income and Vice President at Chapel Hill Durham. It's been my pleasure having you again today on The Edge.
Thank you very much for having me once again. It's really a pleasure to be here.
All right. And thank you, everyone, for watching, and thank you for joining. Please consider subscribing to this channel. We are here every weekend. We dissect the financial market to provide you different insights. So please like this video on your way out, share with your community. I'll be back again next time. Bye. We're out.